Welcome back to the Neuro Finance Masterclass. We have officially hit day 90. I mean, wow, congratulations on making it this far in our 365 Days to Financial Freedom series. Over the last couple of days, specifically days 88 and 89, we spent our time analyzing earnings and physical assets, right? We looked at what a company claims to make and what it physically owns. But in today's explainer, we're completely shifting gears. We're moving away from all that to focus entirely on the single most crucial financial document of them all. Today's theme is the cash flow statement, because ultimately, cash is king. Okay, let's dive into this with one of my absolute favorite quotes. Profit is an opinion, but cash is a fact. This is an incredibly famous saying on Wall Street, and honestly, for very good reason. It lays down a fundamental truth about business that we are going to use to look right past the hype today. You see, an opinion can be debated, right? It can be massaged. It can be dressed up to look pretty, but a fact? A fact is undeniable. You either have the money in the bank or you don't. So here is our roadmap for today's explainer. First, we'll tackle the illusion of profit. Second, the factory paradox. Third, the three streams of cash. Fourth, the architect's prize. And we'll wrap it all up with the action plan. All right, section 1, the illusion of profit, the amateur versus the architect. You know, the amateur investor behaves very predictably. They open up a company's income statement, their eyes immediately dart to the bottom line, the net profit. They see a massive number, and boom, they buy the hype immediately. They just assume high profit automatically means a perfectly healthy company. But the architect? Yeah, the architect knows better. The architect knows that net profit is essentially just an accounting metric. It can be easily manipulated, legally mind you, by various accounting tricks, depreciation schedules, and non-cash adjustments. The architect doesn't trust the opinion of profit. Instead, they follow the cash. They track the actual physical bloodline of the business. Moving on to section 2, the factory paradox, how profitable companies die. Think of a business like a human body. It might look incredibly muscular and strong on the outside. That's your profit, your revenue. But it can still drop dead. And this brilliantly illustrates exactly how. Let's walk through this factory story step by step. Step 1. The factory sells $10 million worth of goods to a major client on credit. Boom. On the income statement, they legally record $10 million in revenue and a massive profit. The company looks incredibly strong. But wait, the client has 6 months to pay. Step 2. The factory still has to pay its workers, pay the electricity bill to keep the lights on, and pay its taxes this very month, in cold, hard cash. Step 3. The factory runs out of physical money in its bank account before that 6-month window closes and the client finally pays. The result? Bankruptcy. A legally recorded $10 million profit did absolutely nothing to save them. So what was the official cause of death here? Lack of liquidity. To go back to our biological metaphor, cash is the blood supply of the business. If the blood stops pumping, the body dies, no matter how muscular it looks. It completely ceases to matter how profitable the company looked on paper. If there is no liquid cash to meet immediate obligations, it is game over. Which brings us to section 3, three streams of cash, the anatomy of the cash flow statement. This document is just beautiful because it strips away all those clever accounting adjustments and shows you only the physical money moving in and out of the company's bank accounts. The absolutely crucial point here is understanding these three distinct streams. First, operating cash flow, or OCF, which tracks the core business and absolutely must be positive. Then we have investing cash flow, ICF, which tracks the buying of assets, where negative is actually often a good sign. And finally, financing cash flow, FCF, which tracks the movement of money between the company, its lenders, and its shareholders. Let's zoom in and look at each of these individually, shall we? First up is operating cash flow, or OCF. This is exactly what it sounds like, the physical cash generated directly from the company's actual day-to-day core business. If they're a coffee shop, it's the cash from selling coffee. If it's Apple, it's the cash from selling iPhones. Now hear me now and hear me with absolute authority. This number must always be positive and it really should be growing. If you ever look at a company that boasts incredibly high net profits on their income statement, but their operating cash flow is negative, you need to run away immediately. That is a massive red flag. Next, we have investing cash flow, or ICF. This is the cash spent on or generated from buying major physical assets, like new equipment, building new factories, or even purchasing securities. Now, it might seem a bit counterintuitive at first, but seeing a negative number here is usually a very good thing. Why? Well, because a negative investing cash flow means the company is spending money to invest in its own future growth. They're out there actually building the infrastructure for tomorrow's success. Let's move along and see how this builds into our third stream, financing cash flow. This stream is entirely about how the company funds itself. It tracks the physical cash moving in from borrowing money, or the cash moving out to pay back old debts. It also tracks the cash leaving the company to distribute dividends to shareholders, which, if you remember, we covered extensively back on day 81. This whole section essentially tells you how the company is managing its external relationships with the very people who give it capital. All right, section 4, the architect's prize, free cash flow. Now, what's really interesting about this is if you imagine a company's total incoming cash as a giant donut. First, they have to pay their operating expenses, salaries, rent, taxes. That's one big slice gone. Next, they have to pay for equipment maintenance, keeping the machines running, fixing the servers, all of that. That's another slice gone. The pure, raw money that is left over in that third, final slice, that is free cash flow. It is the unburdened cash that remains only after all basic survival and maintenance expenses are paid in full. And why is this so absolutely critical? Here is the true power of free cash flow. This raw money gives a company options. It's the money used to pay you, the investor, your dividends. It's the money used to buy back shares, which artificially lowers supply and pumps the stock price up. It's the war chest used to ruthlessly buy out struggling competitors. And most importantly, as we discussed way back on day 72, massive free cash flow is exactly what allows a company to survive any economic winter. When credit freezes up and banks completely stop lending, the company with free cash flow, they don't care. They have their own internal blood supply. We literally call companies with massive amounts of free cash flow fortresses. They are unimpenetrable. To ground this in reality, just think of absolute cash-generating machines like Apple or Microsoft. The amount of pure cash they generate after expenses is staggering. Or look at Bitcoin miners during a massive crypto bull run. Their free cash generation can be truly astronomical. These aren't just businesses, they are fortresses built on a solid foundation of liquid cash. Finally, Section 5, the action plan. Your cognitive task. Listen, in this masterclass, we don't just consume information, we build our neuro fitness. So here's exactly what I want you to do today. Step 1, open your favorite financial screener and look up a company you currently own or are actively tracking. Step 2, completely bypass the income statement and click directly on the cash flow statement tab. Step 3, I want you to look at the last 3 years of data and directly compare their reported net income to their actual operating cash flow. You are performing a diagnostic test right now, acting just like a true architect. And when you look at those two numbers side by side, I want you to ask yourself this crucial question. Do they actually match? Or is the physical cash severely lagging behind the reported heavily hyped profits? You have to train yourself to look past the narrative on the cover and peer directly into the bank account. Because remember, the amateur buys the hype, but the architect follows the cash. Thank you for joining me for day 90 of this masterclass explainer. Go check your portfolios, follow the bloodline, and I'll see you next time.